Michael Burry didn't just short another industrial stock. He didn't target a flashy tech name, a semiconductor giant, or an obvious AI leader. Instead, he went after something far more unexpected. Caterpillar is one of the world's biggest construction and heavy machinery companies. At first glance, it looks completely unrelated to artificial intelligence. AI is software, chips, data centers, and algorithms. Caterpillar builds bulldozers. So what's the connection? Why would one of the most famous contrarian investors in the world use an industrial company as a way to express a view about the AI boom? Because in Burry's framework, this isn't about construction equipment at all. It's about something much bigger, the physical cost curve behind the AI revolution and where we might be in it right now. And that's why, in his view, this trade might actually be one of the clearest AI macro bets hiding in plain sight. Intro: what most people misunderstand. When most investors think about the AI boom, they think in digital terms, NVIDIA GPUs, Microsoft Cloud AI models, software productivity chatbots, and automation. It feels abstract, clean, code-based. But that's only half the story, because AI doesn't exist in a vacuum. Behind every model, every training run, every intelligent system is a massive physical backbone. Data centers consume enormous amounts of electricity. Cooling systems operating 24/7, high-density server farms are being built at scale. Power grids being upgraded. Land being developed for infrastructure mining, and raw materials feeding chip production. AI may be digital in output, but it is industrial in input. And that's where Caterpillar enters the picture, not as an AI company, but as a proxy for the physical expansion phase of the AI cycle. Why is Caterpillar even in this conversation? Caterpillar is not a tech stock. It builds the machines that build the physical world. Excavators, mining trucks, bulldozers, earth-moving equipment, heavy industrial engines, infrastructure, construction, systems. So why does that matter for AI? Because AI expansion requires one thing at scale: massive infrastructure build-out. And that build-out is not theoretical, it is extremely physical. Every hyperscaler expanding AI capacity needs 1. Data center construction at an unprecedented scale. These facilities require massive concrete foundations, steel structures, industrial excavation, transportation of heavy materials, specialized cooling infrastructure. This is not software work. This is construction at industrial scale. 2. Energy infrastructure expansion. AI is power hungry, which means new power plants, grid upgrades, substation expansions, utility-scale construction projects. All of this requires heavy machinery. 3. Mining and raw material demand. AI hardware depends on copper rare earth elements, steel semiconductor inputs. This means expanded mining activity globally. And mining is one of Caterpillar's core markets. So on the surface, AI growth should be extremely bullish for Caterpillar. More AI, more infrastructure, more machinery demand. That's the simple logic. But Michael Burry's argument challenges that surface level assumption. What Burry is really betting on Burry is not making a simple Caterpillar will go down call. He is expressing a cyclical view of AI capital spending. His core idea is this: markets may be overestimating how long the current AI infrastructure boom can sustain its current pace. Right now, we are in a phase where AI has triggered a massive global investment cycle. Hyperscalers are spending aggressively. Data center construction is accelerating. Infrastructure suppliers are seeing strong demand. Industrial companies are benefiting from the build-out. But Burry's concern is what happens after the initial rush. Because in every major investment cycle in history, phase 1, expansion begins, new technology emerges, and capital floods in. Phase 2, acceleration, everyone rushes to build capacity as fast as possible. Phase 3, overbuild, risk supply starts exceeding near-term demand. Phase 4, normalization, spending slows, expectations reset. Burry's argument is that markets may currently be pricing Phase 2 and Phase 3 as if they are permanent, and that's where mispricing happens. The key insight: AI demand is digital, but cost is physical. This is the central idea behind the trade. AI demand looks infinite on paper, but physically scaling it requires time, materials, energy, labor, capital expenditure, and those constraints matter. Because while AI usage can grow exponentially in theory, infrastructure cannot scale infinitely without cost friction. So Burry's focus is not on whether AI will grow, it is on whether the market is confusing long-term potential with short-term spending intensity. And that distinction is critical, because markets often price stocks based on current momentum, not future normalization. Why this trade looks like an AI bet in disguise at first glance? It's simple. Short Caterpillar Inc. Undergo bearish view on industrials, but at the macro level, the signal can be more nuanced. It may actually reflect a view on the AI capital cycle. Not traditional industrial weakness, AI infrastructure investment may be approaching a local peak in growth rate. The initial build-out phase could be maturing faster than consensus expects. Capex momentum may normalize from extreme acceleration to steady-state spending. Industrial beneficiaries may already be priced for peak cycle demand, so the trade isn't necessarily anti-AI. It can be interpreted as a bet on the timing of AI-driven capital expenditure, not the direction of AI itself. That's why it's not a contradiction. It's simply a different layer of analysis, moving from story-level AI optimism to cycle-level capital reality. The role of the bezel in this view, this framework, connects directly to Michael Burry's concept of the bezel. The bezel describes a phase in which investment activity feels like pure wealth creation. Spending is mistaken for durable economic growth. If you enjoyed this breakdown, make sure to like, subscribe, and turn on notifications for more deep macro and market storytelling. And drop a comment. Do you think AI infrastructure spending is still early cycle or already entering late cycle overheating?